Hi, and welcome to this edition of the Insurance Experts. It's my pleasure to have on the line Andre Gordon. Andre is an expert in business succession planning and personal financial planning, and so it's my pleasure to have him on the show today. Thanks for joining us.
Thank you, Mark. I appreciate the opportunity to join you.
So, you have an interesting background, which is you didn't start off your career in financial services. Tell us a little bit more about how you got into it.
Yes, Mark, I actually spent 15 years in corporate America, specifically in the medical device and pharmaceutical industry. And about 10 years ago, I made the transition from that industry into financial services. And on the surface, those two look like they are completely polar opposites. But what I started to understand is that there's a lot of synergy between the healthcare industry and the financial services industry. Because as you probably have heard, health is wealth. And so being able to have a healthcare perspective added to the financial services and financial planning background, I think gives me a unique perspective to add value to my clients and audiences that I speak on any particular topic. And so I think that helps me come at it from a completely different lens.
Right. And I think a lot of people are looking at insurance kind of in the healthcare space, whether it's life insurance, health insurance, long-term care insurance, which is, of course, what I do. It impacts everybody. And I know today we're actually going to talk a little bit about long-term care insurance. So tell me a little bit about how you incorporate long-term care into clients' overall financial plans.
Yes, Mark, I think one of the things that has been a part of my planning for clients is looking at long-term care as a necessary option along with a number of other pillars of the financial plan. Certainly, being able to save for retirement is important. Having diversified assets from a tax perspective. But the long-term care piece is a necessity because it's not a question of if, it's a question of when, if you look at the statistics. And the statistics say that there is going to be 60 to 70% likelihood that you're going to experience any type of long-term care event. So once you experience the event, it's too late to plan for it. So you have to take a proactive approach and looking at adding long-term care planning to any financial plan. That's the foundation of the plan, like you have a foundation of a house. And then you can be able to build on that foundation. And so I incorporate long-term care planning discussions with all of my clients, whether they're in their 20s, their 30s, or certainly in their 50s or 60s. That is an important discussion because it has to become a necessity of any financial plan.
Right. And it's never really too early. It's never too late. And I know, first you become aware of it, usually through a personal experience. And I know you're no different. Tell us a little bit about your personal experience and how long-term care has impacted you.
Well, Mark, one of the things I share with any prospective client or audience that I'm in front of is my own personal story, because I have a passion for wanting to educate and move people to action. And my own personal story deals with my own mother. And my mother was one of my first clients that I was looking to incorporate long-term care into her financial plan. We had gone through a series of illustrations and found the right plan for her. And we decided to put her into underwriting. And during the underwriting process, unfortunately, or fortunately, depending on how you look at it, the underwriters were able to diagnose her with Alzheimer's dementia.
Oh, wow.
So that began a process of what now do we need to put in place? Because obviously, from that standpoint, she was not going to be able to qualify for any type of long-term care insurance or any long-term care coverage. And so the plan B became more of a family plan B, where my other siblings and I had to come up with a care plan for her as her illness began to progress. That was about 5.5, almost 6 years ago. And now we are in a space where she needs 24-hour care. The family is providing most of that with some supplemental care from some outside nursing agencies. But it gives you a context that I provide to clients, is that it's not a question of when you need to do this, whether you need to do it when you're in your 50s or in your 20s. If your health begins to deteriorate, that option is removed from the table. So while we have our health, and while we know what that given is, this makes perfect sense to go ahead and try to put certain parameters in place to be able to plan for that inevitable event.
Yeah, what a powerful story. I mean, I hear this a lot actually, where underwriters kind of actually find out things about the client. Sometimes they don't even know. The doctor didn't even tell them they had something, and the underwriter from the insurance company is telling them. That happens quite a bit.
Yeah.
But so sorry to hear about your family, but I'm glad you're able to incorporate this story into helping other clients. And I know recently you had a situation that was kind of more of a positive spin on the same type of theme. Tell us a little bit about the client you worked with on her plan and kind of her resistance to long-term care in that conversation.
Yes, as I said, I shared that story, personal story, with all of my prospective clients or audiences that I'm talking about planning. And this situation was no different with a particular client who was a very successful executive within the healthcare hospital space here in Milwaukee, Wisconsin. Had done very well for herself financially, had put in a lot of the pillars of the financial plan that we had talked about and recommended in terms of saving, maxing out her retirement accounts. She had built up a very nice cadre of assets, a nice savings plan, and was well on her way for retirement. The one area that she did not have was on the long-term care side. This individual was not married, did not have any children, and so it was very difficult for her to see the connection on why she needed that. And so over a series of months, between 6 and 9 months, we had a series of discussions, and ultimately she went from being resistant to being accepting and wanting to go ahead and put forth the plan to put in some long-term care coverage with her blessing. We were able to successfully place that for her. And so we looked at that. She had a really solid plan. And now all we needed to do was continue to maintain, almost put her plan on cruise control and just make little adjustments here or there. About a year later, this client had a stroke. She was in her late 40s, early 50s. And for a period of about 90 to 120 days, she was in a coma, could not communicate with her, wasn't sure what the prognosis was going to be. But anytime you hear stroke and the level of hospitalization that she went through, the prognosis doesn't appear to be very good. But what was the benefit is that I was very satisfied that we were able to put the plan in place. And although I was not prepared necessarily to activate it in her early 40s, late 40s, early 50s, I was satisfied that if we needed to activate it, we could.
Right.
The beauty of the story is that this client ultimately made a full recovery and was able to return back to her normal activity, didn't have any cognitive effects or speech delays, and virtually was restored back to her previous capacity. And so the story that we have been able to communicate was we were glad that the plan was in place. We're thankful we didn't have to execute it, but we now know that if we need to execute it, whether it's sooner rather or later, the client is in a much better position that she can have direction and discernment of her own care, and that her portfolio that she's been able to amass is protected against a long-term care event.
Wow, that's awesome. And I have a personal story too, where I had a close relative who also had a brain aneurysm, which is like a stroke. And she hadn't gotten her long-term care coverage yet. She was close actually to getting it, but she just hadn't gotten it. And that disqualified her from the other options. So you might say, hey, she recovered in full. That's great. She didn't need the insurance, but now it limited her options. Tell us a little bit about your client, though. I know you have kind of an interesting ending to this story too, which when you reviewed her plan, you were actually looking at some other options. And what did you find out about that?
Well, absolutely. When she recovered from the stroke and back to her normal capacity, we continued to redo our annual reviews, and in my opportunities to look at some other resources, we had initially put in a standalone long-term care policy that provided her a certain monthly benefit for a certain duration of time, that could be used for any one of the three: nursing home, or assisted living, or at home care. But when we put in the long-term care for her, the marketplace didn't have a lot of what we call hybrid options. And as the market has continued to develop those type of products, there are a lot more available options in terms of hybrid products where you could attach a rider to a life insurance policy and be able to have that tied to the death benefit. And so it's not a question of a use it or lose it type of strategy. And for this client, that fit her perfectly because, again, as I mentioned, she wasn't married, didn't have any children. So the protection of her portfolio was more from a income flow perspective and a tax perspective, rather than I need to ensure that these assets are available for someone else. And so this became much more of a perfect fit. And because she had fully recovered and the time duration was significant enough, we were able to place her with a hybrid product at a better health rating than she had initially gotten when we did the long-term care planning for her several years ago. So we enhanced what she had already put in place from a planning perspective. And again, the silver lining of the story is because she had recovered fully to her normal capacity with no issues, she was able to be considered for long-term care underwriting.
And I would say that's probably more of an unusual, exceptional situation where she's recovered enough. Usually it does impact your ability to get coverage later, but it's great that she was able to kind of see both sides of that and get ultimately the plan. And I'm sure she related more to it now that she had this experience and why it was so important to have.
I think you're exactly right, Mark, is that the issue is, while you know what your health is today, you know what it is, now is the time to take advantage of it, because tomorrow could be a vastly different story. And now those options are completely removed from the table. And now you have to come up with contingency plans. And a lot of times that involves family having to step up, both from a physical, emotional, mental, and a financial perspective, to be able to help fill in the gap.
Well, I really appreciate you joining us today. Thanks for your time and for sharing those stories, and hope to have you on future episodes as well.
Well, I appreciate it, Mark. Thank you for the opportunity.